Hello and welcome. This is the Insurance Pro Blog Podcast. This is episode 420. I am Brandon Roberts.
And I am Brantley Whitley.
And you are listening to the internet's favorite podcast about insurance, life insurance. That's how I say that.
It's a long and illustrious list. So
it is. You know, we were buying new appliances for
again.
Yeah, that's I got a washer and dryer story, but we were setting up delivery, and I was going to schedule it for the next time we record this podcast, and it was my wife who's like, "Oh no, that's the podcast day. You can't do that." I'm like, "Oh yeah, that's right too." So the salesman's like, "Oh, what's the podcast about?" And I looked at him. I said, "Insurance. You don't want to know anything more now, do you?"
I have that conversation at least once a week. People go, "Oh, you have a podcast?" I'm like, "What's it called?" I'm like, you don't want to listen to it. Don't worry about it. You like me and think highly of me right now. I don't want you to change your opinion.
Let's just keep it a secret. It'll increase my lot and your standings a lot. So.
That's right.
It did just occur to me though that this is episode 420, and this is going to go live on April 20th. Which, look at that.
There you go. It's almost like we planned it.
There are so many jokes that come to mind. But,
yes, there are, but we're not going to do that.
This being the Insurance Pro Blog Podcast, we'll stay out of that.
Yeah, we're going to stay in our lane. We're going to talk all about. I was going to say something crafty, but now I can't think of what I was going to say. Capital redundancy. There we go. Yes.
Yeah. Sure, we can talk about that.
Yeah.
So. There have been a few people who have offered up an opinion on the strength and resiliency of the life insurance space, more specifically in the context of annuities and life insurance, given current market turmoil and various geopolitical things that are going on that you may or may not have heard about.
Not sure which particular rock you were living under, but yes. If you haven't.
Market's been a little volatile. Bond market has been a little volatile, which is of much greater note, and one might even argue concern. Yeah. And this is a good time.
As it relates to the insurance industry, for sure.
Yeah. This is a good time to kind of evaluate and go through the various implications that the insurance industry faces, and today much more focused on annuities and annuity contracts, companies that are heavily engaged in issuing annuity contracts, than life insurance per se, because it wasn't that many weeks ago that we did a riveting podcast on life insurance and tariffs that you should go back and listen to if you missed, because you could pick up some very crazy insights.
You could find out they're not connected at all. So there you go. By and large, in all seriousness, the impacts to the annuity industry are going. Trying to think of how I want to say that. I'm not saying the annuity industry is going to be impacted. The concerns because of the nature of annuity contracts and the liabilities and the timing of those liabilities is much more volatile than the life insurance industry. So that's why this is timely. Right.
So as any longtime listener of the Insurance Pro Blog podcast knows, the life insurance industry is extremely well capitalized, which makes it quite resilient in times of market turmoil. If we go back a few decades and look at various major economic events, so dot-com bubble bursting, the 2008 collapse, the COVID initiation, those were periods of some pretty intense hand-wringing. Yeah. There were various companies and or industries that were very vulnerable to what was going on at the time. And yet, the life insurance industry kind of sailed through all of those moments with relatively unremarkable circumstances.
Right. Yes.
And this happens in large part because life insurance companies, and I want to specifically note life insurance companies. So some people might hear me say insurance companies, and they might think about those companies that are on your side or your good neighbor. And look, they're doing well, but they don't have quite the same setup and resiliency. That's not to say that you should run out and change your car insurance. I'm not saying that at all. I'm just saying that the life insurance industry tends to be a little more stable in these situations. And
well, the property and casualty business, the losses can be quite volatile from year to year because it's based around things like weather, which, you know, is a pretty tough game to play.
Yes. Yep, it is. So the life insurance industry tends to be kind of a non-story in the face of a lot of these things because it is quite well capitalized and fairly resilient in tough economic times.
Yep.
So that said, the good news when it comes to contracts like annuities, which many, many, many retirees are either considering or have made a part of their retirement income plans, do at least come up as a question when we start seeing rampant market volatility. And we also start to hear stories about the bond market showing some weird signaling that would possibly bring upon a little more apprehension. So what goes on with life insurance companies and their annuity contracts while all of these things are a bit up in the air? Those who are heavily concentrated in stocks and, let's say, public corporate bonds, they have definitely seen some periods of volatility over the course of the past several years. We were talking right before we hit the record button how badly the BND, the Vanguard, I think that's Total Bond Fund, right?
Total Bond,
which is a
ETF or whatever.
Yeah, it's an ETF, and it fell hard back in 2002-ish when we had that big decline in both 2022. 2022 rather. Back when we had the big decline in both the stock and bond markets, and it hasn't recovered since.
Right.
So if you had a heavy position or even a moderate position comprised of bonds as a hedge from risk, you're still trying to recover losses that you incurred not that many years ago.
Right.
Stock market's done a much better recovery, but lately things have been extremely choppy.
Yeah.
So people tend to look for other options. Annuities have been a fantastic one to create income, but we've got to address the question. With all of this going on, what are the risks and possible problems that we might face with insurance companies because we might be relying on them to produce a significant amount of income through guaranteed income features of annuities?
Right. That's kind of their whole point.
Yep. So
I should say that's the lens at which we view annuities.
Yes.
They're an income tool.
Some people buy them for accumulation, mostly MYGAs as a sort of CD alternative, which is fine. When interest rates are good on MYGAs,
in fairness,
nothing wrong with that.
The indexed annuity world in the last several years has gotten competitive again for accumulation in a lot of respects, where it really wasn't. When interest rates were super low for that 10-year period, 10-plus year period, they weren't so popular.
Correct. But there's been a change in market conditions that's definitely created a situation where accumulation-focused indexed annuities have much more attractiveness to insurance companies.
Yes.
And you are very correct. Those have a compelling story behind them now.
The upside has become reasonable again.
Yep. So we know, if we are kind of a little deeper in the weeds on the insurance industry, that life insurers can hold a large percentage of their assets in bonds.
Yes.
Now, the specific types of bonds has shifted over the years. Generally, we've always told people, well, it's bonds, but it's typically corporate bonds. And that's still true to a certain degree. But insurers have, over the past several years, started to actually issue private debt to organizations. So now we're talking about holding bonds for companies that are not publicly traded.
Right.
Which maybe sounds a little scary when we say it, but the truth is they're still rated bonds. and quality is still super high. It just turns out to be the case that insurers have found going this direction has created a little bit better rate of return for them.
Mm-hmm.
There's a market to do it, and they're fine with that arrangement. So the one critical thing to understand about bond investment from the perspective of a life insurer, and this is true of both life insurance and annuity contracts, insurance companies buy bonds in order to create income that covers a liability they have committed themselves to through the contract they've issued.
Right. There are guarantees that are provided that they have to account for.
Yep. The significance of that statement is, unlike a bond trading desk, let's say, at a major bank or investment firm that buys and sells bonds largely to take advantage of capital appreciation and worries day in and day out what the mark to market on those bonds is, life insurers are not unaware of this aspect. They're just a whole lot less concerned.
Right.
Because the way life insurers value bonds is typically yield to maturity.
Yep.
Which means they are much more concerned about the bond holding and the income that it represents with the intention to hold the bond for its entire duration.
Exactly. Yeah, they don't have to be concerned about capital ratios in regard to leverage and all the things that an investment company would be concerned about in their bond book. So,
So while the bond market may be,
and that's not to say life insurers don't ever sell them for a capital gain, but that's not why they would buy them.
Yes,
primarily.
Yep. And again, it's also not to suggest that it means nothing to life insurers. However, they are significantly more concerned with the income that it produces, which means they're also significantly more concerned with counterparty risk.
Right.
So insurers are buying bonds that are high quality most of the time because they want to ensure that they're actually going to receive all of the income that the bond contract represents.
Right. Well, you were just talking about the privately held deals that they're doing out there. Mm-hmm. Even with that, which are largely non-rated, right?
They're largely rated in the insurance world. Insurance companies need the rating in order for there to be an evaluation from rating agencies.
Yes. But the combined portfolios are still, what did you say, AA plus?
Yeah, on average, it's somewhere in that range of being high quality.
Yeah.
And we should be clear that when we talk about ratings of bonds in insurance speak, it's not quite the same as it's actually not the same as ratings of bonds.
Yeah.
As we typically see from rating agencies.
Right.
That there's a different.
It's much more stringent, actually.
Yep.
It's much harder to have a higher quality bond portfolio as an insurer.
So even though we are seeing some volatility in the bond market, specifically in treasuries, which industry-wide is like 7-ish%.
Yeah, small.
Of all of the bond holdings that insurance companies have.
Mm-hmm.
So,
and that data goes back to like a few years. We don't have we don't have last year's numbers, for instance.
No. But the likelihood that it's grown immensely is not high.
It's not changed much.
So insurers don't hold much for treasuries.
Right.
There could be an opportunity to buy treasuries.
Sure.
And there have been moments in distant history when insurers have acted as a sort of backup place to start consuming treasuries.
Mm-hmm.
And if yields get high enough, that's what they will do in many respects.
Right.
So,
well, I mean, if you can get the same yields that you're currently getting in corporates, but you can buy treasuries, they're obviously going to do that because that's generally regarded as the lowest risk asset you can own. So,
right.
That would be prudent at that point to do it. So,
yep. And let's not forget that treasuries are purchased by a lot of different entities, including other sovereign nations.
Yep. Heard a lot about that lately, huh?
Where relationships with the U.S. federal government may not be stellar.
Right.
But if you are a domestic life insurer buying debt of the sovereign nation you exist inside, chances are good your relationship with the federal government in that case are decent.
Yeah.
So, not a whole lot of worry there.
No.
Now, there's varying degrees of risk that different styles of annuity contract represent. And in the annuity world, especially when we're talking about income, we basically have three categories, I would say, of annuity contract.
Mm-hmm.
We have variable annuities. Then we have fixed annuities that have some sort of accumulation feature that would one day turn into income.
Mm-hmm.
And then we have your straight up income style annuity.
Right.
That income may be immediate or it may be deferred into the future, depends on the contract and the preference of the individual buying it. But those in general would be the three categories of annuity that could exist. And they range in terms of risk, kind of variable annuities at the riskiest and the income only style annuity being the least risky.
Right.
Because the insurance company knows with the income only style exactly what the provisions and the outstanding liabilities are going to be.
Right.
When it comes to variable annuities, those liabilities are a little bit less clear. You have to speculate a bit on what could potentially happen.
Yep.
The prevalence, that's the right word, of those style variable annuities, which tie an income benefit loosely to the performance of the investments of the annuity contract.
Yeah.
Are not nearly as widely available as once was the case.
Right. Certainly not with as rich a benefit as they once had.
We once liked to use the term the variable annuity arms race because there was a time, quite literally, when every company was out there telling us, we'll give you 7% guaranteed, we'll give you 8% guaranteed, we'll give you 9% guaranteed per year for some period of time, and then you can withdraw from there. It was a whole lot of we're this number, we're that number.
Yep.
And that's basically the deal with most variable annuities.
So much so that many players in the industry lost their minds and put themselves out of business. So.
Yep, they did. They way overexposed to the risks. They way underestimated what it was going to take to provide this benefit, and just how popular the offering was going to be. And nobody wanted to be the last one out of the room on this.
Yep.
And so this was. There was one company in particular that kind of playing, I guess, magical chairs, and the music stopped, and they were the last to sit down.
Yeah.
And that had ugly consequences. So today we have far fewer of those options available with far, far less attractive benefits than existed.
Yeah.
Almost
and
20
people
years
may be
ago.
thinking, well, it's a variable annuity. What's the risk to an insurer? It's not the variable part. It's the guaranteed part.
Correct. So functionally, we're talking, I give you $100,000 and you're going to tell me that the account balance will have some guaranteed accumulation as far as an income bucket is concerned. And then there's the possibility that the underlying investments could perform better and push that guarantee income benefit up even higher.
Yep.
And then it's up to the insurance company to one day say, all right, for the rest of your life, we'll pay you this income benefit. They have to create the assets capable of backing that income feature.
Right.
Which, again, you can do some math and you can figure out what the likely liability is and structure assets accordingly. But if you're wrong, that could result in losses.
Mm-hmm.
Alternatively to that is your basic single premium immediate annuity, where I give you $100,000 and you start paying me almost immediately.
Yep.
And I have an income that's guaranteed to me over a period of time, usually for the rest of my life.
Yep.
And there's nothing that's going to happen in the market that's going to change that result. That's a far less risky proposition for most insurance companies.
Yeah.
Because even for those who live for an extraordinarily long time, for the most part, we can predict when people are going to die.
Yeah.
At least if we have a large enough group of them.
Yep. And it's easy to match the liability to the income.
Yep. So insurance companies
that's also why those immediate annuities tend to be the pricing of them tends to be volatile, not the income. Like once you sign the contract, you're guaranteed the income. I don't mean that. I mean, we could look this week at what the payouts would be if you did it, and 2 weeks from now it could be vastly different.
Could be, depending on what happens.
Hasn't been that way of late, but about a year ago or so, that was a big deal. When interest rates started to really go up, that may have been a couple years ago. My brain thinks everything was like, oh, that was just a couple months ago. Like, that was 6 years ago. That's kind of how things work. But my point being, because of that liability that they have, they tend to manage that aggressively.
Yep. So in between all of this is the fixed annuity contract that has some kind of accumulation feature that also has some sort of accumulating income benefit. This is most commonly found in indexed annuities.
Mm-hmm.
And there's not zero risk here, but there is far less risk in terms of trying to speculate what might happen with the market, as would be the case with a variable annuity. For the most part, the risk that these pose to insurance companies from we're not going to be able to make this guarantee happen, we've never actually seen that unfold.
Right.
We've seen some companies do things that we think might be headed in the direction of them worrying about their ability to keep some of these promises in place. The good news is none of those companies are still doing it.
Right.
So you don't have to worry about accidentally buying one of them. And most of the companies that are heavily engaged in the annuity space, be it variable annuities or indexed annuities, they tend to derive a significant amount of income from their annuities and profit from their annuities, which would be indicative of the fact that they are managing those risks quite well. We also continue to see the industry improve its capitalization, despite several circumstances that are unfolding right now that are making people a little uneasy about markets in the broader economy. And if we continue to see kind of a unwillingness to go down in interest rates, higher bond yields, that's actually a pretty good thing for the insurance industry, the life insurance industry.
Yep.
It will be able to provide the features that it has rolled out for contracts and continue to be able to buy assets that well exceed what it needs to earn to provide those benefits. And those are profits that insurance companies use, and many of them use them to further enhance the benefits of insurance contracts.
Absolutely.
They play a role in increasing cap rates on indexed accounts. They play a role in increasing the fixed interest rate on a fixed account. Wasn't going to spend a whole lot of time about life insurance, but they also play a role in the dividend payment for whole life insurance and the handful of dividend paying annuities that exist today, which is not many. But that higher interest rate feature is something that insurance companies are not upset about at all. I realize that there are other people who may not like it in the context of what it does to mortgages and borrowed money and things of that nature. But for the life insurance industry, it doesn't cause much concern.
Absolutely.
So ultimately, there's nothing that stands out right now that causes any serious concern about the insurance industry with respect to annuities. And so as individuals look into the future to try and figure out, all right, things have been a little choppy lately and I need to guarantee some degree of income, looking at annuities is not a bad place. And there are very, very few things, systemically speaking, that stand out as worries regarding the life insurance industry. But a number of good things that are positive in terms of establishing a guaranteed income.
Absolutely. Yeah, for sure. Some of the best numbers we've seen in the last decade, for sure.
we have been able to do things with annuities that we've not been able to do for quite some time.
Yeah.
And that's a great thing. And it's also very helpful that it's coming from a company inside an industry that is well known for its resiliency in tough times.
Mm-hmm.
So as a certain amount of uncertainty ramps up, which understandably causes a certain amount of nervousness among individuals, it's always great to know that the life insurance industry has options to provide people with something they desperately need, income, without a substantial amount of worry over whether or not that income deal is sustainable long term.
Right. Yeah. It's great it's great peace of mind.
Mm-hmm. So, the moral of the story is buy an annuity.
Is it really? Sure, why not?
Actually, I think the moral of the story is life insurance will continue to shine brightly in the face of uncertain times.
Yeah.
And we are currently standing in a situation where there's a number of things going on that cause people some worry, but they're actually things that can make an already strong industry a little bit better in terms of what it can offer. So life insurance in companies, annuity contracts specifically, are very well positioned to be a flight to safety for income-focused individuals.
Yep.
So if you are seeking out some way to create income with your retirement assets, you can do that with annuities, and you get the benefit of a very solid number that's not going to fluctuate and has very, 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 very little doubt of failure.
Right.
Or for failure, not of. Either way.
Yeah.
So that's I think everything that I could come up with for today.
I clearly have run out of words.
So with that, I am Brandon Roberts.
And I'm Brantley Whitley.
And we will see you next week.